Okay, hello everyone, it's William DeBoyk here again for pipjunkies.com. Today we're going to be talking about how do you trade Forex, subject that we've covered, I suppose, fairly briefly so far. Now, in Forex, obviously, we all know that we're going to be buying and selling currencies. You should know that by now, otherwise there's been some kind of mistake somewhere along the lines. We've also explained that buying and selling in Forex is fairly similar to doing in the stock market. So, if you've been doing that anyway, you'll probably know most of what I'm about to say anyhow. So, as we mentioned in Forex, okay, when we're buying one thing and simultaneously selling another. If we're buying a particular currency pair, we expect the value to go up. If we're selling a particular currency pair, we expect the value to go down, and the fluctuations in price is how we make our money. Now, I'm going to give a very basic example of this here, which should help everyone and hopefully make things a little bit clearer for anyone who is slightly confused. So, we can see in this example here, okay, we're given the example of buying 10,000 euros with dollars, okay? Now, we can see in this example here, the exchange rate of the euro versus the US dollar is 1.2800. In other words, it's going to cost us $12,800 to buy 10,000 euros. So you can see from the very top of this chart, straight away we lose $12,800. Well, we don't lose it, we change it into euros. So we've got exactly 10,000 euros and we spent $12,800. Now, they say 2 weeks later we change that money back over, okay? But the value of the dollar is now worth, the value of the euro against the dollar is now worth 1.3800. In other words, the value's gone up. The euro is now worth more against the dollar than it was 2 weeks ago. So in this example here, if we're changing our money back into dollars, we can now get $13,800 for our 10,000 euros that we held onto for 2 weeks. So we've just made a profit of $1,000 in the space of 2 weeks. Okay, simple as that. And that's basically what we're doing on a day-to-day basis. Now, you're not necessarily going to be placing trades for 2 weeks. You could do. Majority of the stuff that most people do for retail traders is typically intraday trading. So you're looking for different fluctuations over the space of a day. But this is just a example of 2 weeks. I don't think this ever happened. I've just made this up. But the example stands very true. Okay, so having said that, we now need to talk about the actual currency's quote prices, how they look, how they're valued. So in this example here of my nicely drawn chart, you can see that we've got the euro versus the US dollar and how that equates. So the currency on the left, in this case the euro, is always known as the base. Okay, the base currency is always the currency on the left. The quote currency is always the currency on the right. So in this example here, the euro is the base, the dollar is the quote. We can see here the value is 1.2800 still. So that means that you need to spend $1.28, so $1.28 to buy 1 euro. Okay, that's basically what this means. So the value of the euro versus the dollar. So to buy 1 euro, it's going to cost you 1.28, $1.28 to buy 1 euro, and it's going to 1 euro will get you $1.28. Okay, so the euro is worth more than the dollar. It's not until we have 0 point something that means the dollar's worth more. So in this particular case here, 1 euro will get you $1.28. Okay, simple as that. Now then, like I said, we're buying or selling a particular currency. Okay, so if we do expect the value of the euro to go up, we're going to be buying it. It's also known as going long. Okay, so if you're long in a position, it means you're buying. At the same time, if you expect the value to go down, you'll be selling, otherwise known as going short. Okay, now we're doing this, it'll be based on a number of things, and this is what the next set of videos are going to be going into, some technical analysis, fundamental analysis, explaining the ways that different people look at charts and decide how, and if, what's going to cause the value of a particular currency to go up or down. But at the moment, we're just, speaking completely theoretically here. So the base is always on the left, the quote's always on the right. In this case here, we've got the euro versus the US dollar, and 1.2800 is the differences in prices. Okay. Now, when you're looking at an actual offer, okay, from your broker, it's going to look something like this. This is from MetaTrader 4, which is the software people use to trade. It's probably the most popular software at the moment that people use for trading Forex. You may want to use a different one yourself, that's fine, but they'll all look fairly similar to this. And the information I'm going to be talking about is relevant to all of them, not just some of them. It's relevant to every single one, no matter what software you use, which broker you use, whatever it may be. Now then, when you're trading currencies, okay, you get something which is known as the bid and the ask price. Now, all Forex quotes, the bid is always lower than the ask price. Okay, so in this example here, we can see that the bid price is 1.4374. The ask is 1.4376. The ask is higher than the bid. Okay. So the bid is basically the price at which your broker, not yourself, keep this in mind, okay? This is where things can perhaps get a little bit tricky, but it is very simple, believe me. The bid is the price at which your broker is willing to buy the base currency, okay? And the ask is the price at which your broker is willing to sell the base currency. And the difference between these two here is what's known as the spread. Now, when you're placing a trade, if you're buying, the broker you're going to be buying from the ask price. So you're going to be buying from the higher price. Now, every trade you place, you're going to start off with a small loss, and that's where the spread comes in. Now, we can see in this example here, I didn't pick the most perfect example, did I? But this ignored the last digit on the end just to make the maths easy. 1.4374 and 1.4376, the gap between the two there is, well, it's 1.9 actually, including the full thing. But this to say so the gap is 2, right? 1.4374, 1.4376, the gap is 2. So that means we have a 2 point or 2 pips is what they're known as, and we're going to pips in more details. That'll actually be in the next video. But we have a 2 pip gap. Okay, so that's 2 pips. So we're straight away down 2 pips when we place a trade, because I'm buying on the ask, but the broker's buying on the bid. So I get in on the ask price, but remember the bid is lower than the ask price. So I'm buying at 1.4376, but the broker will only buy it off me at 1.4374. So that means I've lost 2. So if I buy in and then straight away without the price changing decide I don't want it anymore, I've automatically lost 2 points, okay? And it's the complete opposite for selling it. So if I want to sell it, I'm selling at the so I'd be selling at the lower price. Okay, so if I was to go and sell a particular currency, I'll be selling off of the bid, okay, rather than buying off of the ask. So I'm buying off of the ask and selling off of the bid, but for the broker it's the other way around. And I say that gap is how they make their money. So if I'm selling at the bid, okay, 1.4374, I need the currency to go down in value, but the broker will only take it back at the higher price. So therefore, you know, if the price is worth more than what I paid for it, I've lost money, okay, because the broker's only going to give you what it's worth. So you would have lost money because it's actually worth more than what you brought it for, okay. And that's basically how the broker makes their money, and the gap between the two is known as the spread. So like I said, it may seem a little bit weird. Hopefully that makes sense. It may be a little bit complicated. It's kind of hard to explain it in a video. It's something you probably have to sort of experience for yourself, but that's basically how that part works. Now, we're just going to give a few examples of certain things that people will be looking at, okay? This is just to try and sort of plumb this into everyone's head a little bit better. So the Euro US. If I expect the euro to go up in value and the dollar to go down in value, what am I going to be doing? I'm going to be buying the euro. I'm going to be going long on the euro. If I expect the dollar to go up in value and the euro to go down in value, I'm going to sell, okay? I'm selling or buying the currency on the left, base currency. So I'm always trying to I'm always buying or selling the currency on the left. And it's always their value versus the currency on the right, okay? The quote currency. So I'm buying the euro, simultaneously selling the dollar, selling the euro, simultaneously buying the dollar. If I expect the euro to go up in value against the dollar, I'd buy the euro. You know, why would I buy the euro? Well, it could be based on my technical analysis, which we'll be going into very shortly, or it could be based on, you know, fundamental analysis. You know, are the Eurozone having problems? You know, is there political problems at the moment? Is there this? Is there that? Whatever it may be. So that would influence my decision when placed on a particular trade. The same with the pound. If I expect the pound to go up in value against the dollar, I'll buy the pound, sell the dollar. Simultaneously, if I expect the pound to go down in value against the dollar, I'll sell the pound, buy the dollar. I won't give the example on the last two because I'm sure you guys, I'm sure you get the point. So hopefully that all made sense, and that will be it for this video. Keep an eye out for the next one. It will be out very shortly, and yeah, take care for now. Thank you.